Hi everyone, it's Gary Wilson. Welcome to this week's Wealth Wise Wednesdays. Welcome aboard to all of you. Some of you just jumped on from the weekly webinar I do. Tonight's subject, very appropriate for the season, is some tax strategies you can use if you're a real estate investor, okay, and or a real estate professional, like you have a property management company, you're an agent or a broker, you're in commissions. In any case, some awesome strategies. Let me adjust this real quick here so it's a little bit more user friendly. Okay, so what I want to do is I'm just going to give you a couple of them, okay? Some of them are quite obvious and simple. Some of them are a little bit more complex. So let's start with a complex one. It's called, there's what we call passive losses in real estate. These are paper losses. They're not actual dollar and cent losses. So in other words, if you own rental real estate, or any kind of income producing real estate, you get to take what's called depreciation. Depreciation means every year for 27 and a half years, here's what happens. Let's say you buy $1 million property. The IRS is going to let you deduct an expense, a paper expense. It's not an actual dollar and cents expense. Over the next 27 and a half years, in other words, they're going to assume that your property has what's called a life expectancy of 27 and a half years. Now, we know most homes are going to last way more than 27 and a half years. Again, this is just a privilege for owning real estate. What that means is about every year, you get to take about 3.4, 3.5% of what you pay for the property as an expense, even though it didn't cost you a dime. Okay, it's not like a repair that costs $3,000. This doesn't cost you a dime right now. Okay, so you do that deduction on your tax return. You've got your rents, you've got your actual real tangible expenses, taxes, insurance, maintenance, repairs, so forth and so on. You're left with your net operating income. Well, you get to deduct further from that net operating income the 3.4%. In other words, 27 and a half years divided by, let's just again, $100,000 is 3,000 something per year. You didn't have to spend that 3,000, but you get to write it off as if you did. Now, here's the downside of using depreciation is it does give you temporary use of the money, but when you go to sell the property years later, you got to do what's called recapturing that depreciation, and they're going to basically deduct that from your cost basis. So let's say you bought a house for $100,000, you rented it out. Every year you took depreciation. What happens is, in effect, is you're lowering your cost basis from 100,000 all the way down to zero. So let's say you sell the property for 200,000 years later. Let's say you owned it for 30 years or 29 years. So 28 years you take your depreciation, 27 and a half years, right? 28 years. Year 29 you sell it, and you bought it for 100, you sell it for 200. You're not just going to pay taxes on 100,000 that you made between the two purchase and sale, right? You're going to pay capital gains tax from zero all the way up to 200,000 because you took all that depreciation over the years. That's the downside. The good news is, over all those years, you get to use those funds to do more investing. So you get the temporary use of the money. Perfect example of why this is important is this. If you took a dollar and doubled it for the next 20 years, do the math on that. It would come out to over $1 million. But if you had to pay 30% tax on that every year for the next 20 years, it'd only be worth $40,000 at the end of 30 years. That's why we like to do, take advantage of these tax opportunities. Okay, like passive write-offs. So back to passive write-offs. Here's what I was getting. You can deduct up to $25,000 in passive losses. See, that paper write-off, that depreciation is called a passive loss as opposed to an active loss. You can take that up to $25,000 per year as long as you don't make more than $150,000 a year. If you make more than $150,000 a year, married filing jointly, they won't let you take that $25,000 loss. Okay, if you're single, it's $75,000. Well, here's some good news. It's like good news, bad news, good news, bad news. Good news is the tax plan act of 2018 raised those income limits to $500,000 for married filing jointly and to $250,000 for single, which is long overdue because that 150 has been there for a lot of years. Okay, And there's a lot of people in New York City and in California and, you know, all the expensive places around the U.S. are making, a lot of people are making well over six figures, way more than they were 30 years ago, okay? In any case, the tax change was long overdue. So here's a workaround for that. Guess what the workaround is? If you're in the real estate business, right, and you have passive income coming in and you're working 500 hours at it, then you can take more. You can take that passive loss. But here's the solid rule. It's really good for those of us who are um, professionals. We're real estate agents. We have property management. We're in the business 751 hours a year, which is 14 and a half hours a week. Okay, you can do that part time. You can all of those expenses can be written off in that year. You follow what I'm saying? Okay, so if you can prove that you're in the business and you're a professional by working 750 hours a year, 751 to be exact, then you don't suffer from that passive loss limitation. Okay, Jeff just typed something in. Thanks, Jeff, for doing this, by the way. Do you always use accelerated depreciation? That's the next subject, Jeff. Jeff, the answer is yes, I do. It's called componentizing, or basically cost segregation. So in other words, in real estate, the building itself is depreciated at 27 and a half years. Its life expectancy is 27 and a half years, and you get to do that paper write-off under that guideline. But personal items are a 5-year, okay, 5-year lifespan, which means you can write it all off in 5 years, which means 20% of your cost basis you get to write off every year for 5 years. Okay, and we've done that. It's different for vehicles and refrigerators and temporary walls and windows and carpeting and things like that. They all have their different lifespans or different categories: 15-year, 5-year, 7-year. In any case, so what I would do, Jeff, is anything that's not really a permanent part of the building, I would do accelerated depreciation. I would write it off in 5 years, for example. Good example is a partition wall that's not meant to be a load-bearing or permanent wall. Okay, you can write that off that year, even if it costs you as much as a house. Okay, so in any case, that's an example of another strategy, which we call cost segregation. And I tell you what, Jeff, I just went over this in a weekly webinar, but I gave the example of a truck I owned years ago. I bought it for one of my big buildings. It was a big complex. It needed its own vehicle, just for getting supplies, shoveling snow in the winter, spreading salt, all that kind of stuff. Every day back and forth to the hardware store getting supplies. So we bought that truck for the building, okay? In fact, just on the snow shoveling itself, that truck paid for itself in like the first 2 years. It was amazing. Well, we depreciated it. And then we sold the building, Jeff, years later. Based on what we paid for the truck and what we sold for it and accounting for the depreciation, we actually made money on the truck. It was like a flipping, like we flipped the truck. It was the craziest thing. So cost segregation has not only helped me save tax dollars and save money for use for other things, actually helped me make money. How about that? So in any case, cost segregation is another one, guys. Another thing you could do is this. Hang on just 1 second. If you're just starting off in real estate investing, and you haven't even bought your first property yet, you can buy anything up to a 4-unit, a single, duplex, triplex, fourplex, okay, and still get FHA financing, which means you can amortize it for 30 years, get a 30-year term, low interest rate, low monthly payment. As long as you live in one of the units, you can get that loan as a personal loan on your personal residence because you live in one of the 4 units, okay? Now, you got to do that for a couple of years, and then you can move out and rent that other 4th unit out, but you got to follow the rules. The other thing you can do, too, is this. Let's say you've lived there for 5 years and you're ready to move on. You can just refinance it with a conventional mortgage. It doesn't have those FHA restrictions. A conventional mortgage, they don't care if you rent the full thing out or not, okay? So rent out the 4th unit, refinance it, take your equity out and go buy another property, okay? What I'm getting at is you get temporary use of the property and temporary use of the FHA rules, right, for financing, and also get the write-off because it's an income-producing property. Get the write-off large portion of the expenses on that property. So it's a huge strategy for people just getting started. Okay. Um, any case, that's another one. Another one is this, guys, is avoid audits at all costs. Um, it's not the scary thing that people think it is. I've been audited before. One time it was a major audit, the entire return, and it took about a year to go through the audit. But nothing changed on my return. At the end of the year, they wrote me and said, "We're satisfied. Nothing's changing on your return." The reason is in the beginning, I made myself completely available, made my office available, all the files available. I did get prepared. My tax accountant did prepare me for the audit. Did a great job doing that. So I had everything that the auditor wanted, and if they came back for more, I gave them everything they wanted when they came back for more. What I'm getting at is this: as long as you do everything right, you do everything correctly on your return, you got nothing to be worried about. The fact is, guys, they're often just looking for information. That's all they're doing. They're not trying to throw you in jail. They're just sometimes they're not clear on what it is you're trying to show in your return. You got to provide more information, more documentation. Okay, which is exactly what I did. That's typically all it is. The thing is, it still costs money. That audit took a lot of time, energy, and money, right? And I can tell you, one of the biggest triggers for an audit is using some of your home, writing off a room, a bedroom, a spare bedroom, or a basement, or a living room that you convert to an office. Writing that off is for tax on your tax return is an expense because you use it for your business. I'm not saying you can't legally. You can certainly do that. It's a legal write-off. The thing is, it's one of the top triggers for an audit. So I don't want to be audited, so I don't use that. I don't do that write-off. Okay. In any case, that's one thing you can do. Also, make sure if you ever have a year where it's more complex. One example for me is I had a year. I think it was 2012. Man, we sold bunches of properties. I sold and merged businesses. I was going through a divorce, right? So going through a divorce, I mean, my gosh, this was just nuts. And on my tax return must have looked like a nightmare to these guys. Well, that's the year they audited on me. They took 3 years to do the audit. I mean, it was 2015 before they announced the audit, and then they took a whole year to do the audit, but it was based on a return from 3 years before. They have 3 years to call for an audit, okay? In any case, the point is this is, it's not the scary thing that you may think it of. It's just gathering information. But it does take time, energy, and money. And let's say in that home office, I would have maybe saved myself $1,200 or something on taxes. Believe me, that audit took way more than $1,200, okay? So that's why I don't like to do that. Okay, let's see another one. So we talked about passive losses, accelerated depreciation, using FHA rules to get started buying investor real estate, audit proof yourself. Here's another one. Make sure the tax accountant you're using serves other investors. Always look for references, okay? And also ask them, here's what I ask them: have you invested yourself? I always, accountants, attorneys, anybody I work with, even my lenders, I always ask them, hey, by the way, you ever thought about investing in real estate? I used to do that because I'm thinking I'll get some business out of it. And I still do that, by the way. You can get business from asking that question, of course. I'm looking, though, to see if they've done what I'm doing, so I know what they know. I know what I can expect from them, right? We can have meaningful conversations. I know what's going on. They know what's going on. So I always like to work with people who also invest in real estate. It's another strategy. Another strategy is this. On a settlement sheet, you, the buyer, or you can even recommend this for your buyer clients if you're an agent, is have them take some of the seller's expenses, like commissions and transfer taxes, and put them on the buyer side. Now, you want to net the price so that the net difference to the seller is the same. But to your buyer, what do they get to do? Well, at tax time, they get to write that off. The commissions and the transfer taxes, in this example, is a write-off in that year, as an expense in that year. And if they're in a 25% tax bracket and that came to $10,000, well, they just made themselves $2,500. So really, it's like they got the property for $2,500 less, right, than they would have paid otherwise. the net to the seller is the same, right? In any case, I love that strategy. I use it in negotiating a lot. If I'm within about anywhere 3% or less of consummating a deal, I'll use that strategy to get the deal to go through, and it works every time. Okay, guys, we're past the 15-minute mark, so I'm going to wrap this one up here. I appreciate you participating, Lisa, Jeff, Ralph, all you guys. Wonderful to have you on board. If you're going to come to the event this weekend in Anaheim, look forward to seeing you there, man. It's going to be awesome. We got 127 registers this time. So Jeff, this is going to be like, 4 or 5 times bigger than the one you saw in Chicago. I don't know if you're going to come or not, Jeff, but if not, I'll look for you next one in San Francisco in June. Ralph, same for you, buddy. I saw some emails floating back and forth, Ralph, with you. I'm not sure. Ralph, let me know if you got everything you need. Whatever you need, just let me know. Usually Judy, Jody, Beverly take pretty good care of the students. But if you need something, you know how to get a hold of me, okay? All right, guys, we'll see you next week for the Wednesday, Wealth Building Wednesday, Wealth-Wise Wednesdays. All right, hey, Maximo, you're welcome, buddy. Thank you, too. You guys take care of yourselves. God bless. We will see you next week. Bye-bye.